Good morning again. Constantine Salame. I just want to take you through the second workshop. We covered during the previous one financial management with a focus on cash flow management, the importance of it, of being able to manage cash flow forecasts in a very effective way. Now, where are the changes that are coming in terms of your cash flow forecast? They're coming in primarily from the risks that will be hitting your organization in the months to come or the weeks to come. So as important it is to understand cash flow management, it is equally important to understand your risk that you have. And we have a proposal in terms of a framework that we call a risk management framework. So this framework is here to help you understand the risk areas, understand the impact that they will have on your organization, and also understand what are the mitigation plans that you need to put in place if you haven't done so, and making sure that you review those on a regular basis. The whole system is called risk management process. So what does it include? First, would like to thank again USAID and the LED projects for providing this opportunity to sponsor the workshop. So we have here, as I mentioned, it's here about creating this initiative. The LED initiative is to create employment opportunities for Lebanese, and it's at the same time we do it by providing technical assistance to these companies with LED funding a big portion of the cost of it. Overall contract value of about $25 million over a period from 2017 to 2022. A number of other programs are doing similar sort of work also across the country. So let me focus on the same slides. We have here, in terms of the boat, this could be yourself as a leader, this could be your company, it could also be our country. The country is going through very turbulent seas, and I've mentioned how turbulent we are going through over the past few months that we have. And they're all trying to reach this lighthouse. So what we want to do in terms of the best way to predict the futures in turbulent time is to shape it. How do you shape it? You shape it by coming through the development of a comprehensive and shared risk management framework. And this is what the topic of today's workshop is: what it is, why do we need it, how do we use it? So what is it? The risk management framework, or your contingency plan, is a series of different actions. I've mentioned here 6 steps. These are fairly clear steps. These are easy steps. The first step is you list what are the key risk areas that you have. And we could do this with your team in a matter of 2 hours. This is a session. You get your team, you get your members of your boards, and we work together and we list those key areas. Once we have done these key risk areas could be related to the economic situation, the financial situation, the ability to access money, the loss of employees, the loss of customers, the loss of suppliers. So all those are risk areas. So we need to list them. We need to make sure that we understand what these risk areas are among ourselves. So it's not a one-to-one, this is with the entire team that we have, because everybody come up with a different perspective on it. Once you have done this, the second element is you prioritize it. Which are the ones that are most critical? How do you prioritize it? You basically map them, looking at what is the impact. Is the impact of your organization small? Is it medium? Or is it high? And what is the probability of this risk happening? Small, medium, and high. When you go through this exercise, you have prioritized them, you focus on the one that of course are either medium or high impact or medium or high probability of happening. This is what we define as your red zone. So there will be 3 or 4 of these risks which are the red zone. We map them. So this is the way you will map them. You will map them around the impact, and you will map them along the probability of its happening. Once you've done the mapping, which is step 3, you then work together to define a contingency plan. What is a contingency plan? It's for each of these risk areas, what are the 1 or 2 or 3 activities or action that you will take place in order to be able to address this. Let's take an example. If you have, for instance, difficulty to pay your suppliers because you don't have ability to access US dollar, one of the mitigation plan is to ensure that you have an account overseas so that you're in a position to be able to pay them. To have this, you need to make sure that you have customers who are paying you overseas to be able. So this is a contingency plan in case you have difficulty of paying your supplier. Another one could be that you are losing your people. So if you are losing your people because they're leaving to Dubai, one of the contingency plan is to ensure that you have maybe an employee stock option program where you are providing your employees with the ability to get shares in the company. They move from becoming employees to becoming shareholders and employees. This is a way to be able to retain your key staff that you have. So these are examples of contingency plan that you have for each of the risk areas that you have done. Once you've done the contingency plan, what you need to do is then list and include these mitigation actions into what we define as our performance management. This is, we will go through it, the balance scorecard. It's on one sheet of paper. It lists what are the key initiatives or key mitigation plan that you want to implement now, not in 1 year or 2 years now. And be able, for each one of them, we have an owner, we have a timing, and then we sit down together with your board, with your advisor, and review how well we are executing on these mitigation plan. So it's not only good about listing them, prioritizing them, mapping them, ensuring that you have the contingency plan, including them in your performance management framework, and if you don't have one, we'll help you develop one. Simple, easy to use, and lastly is to make sure that you have this on a continuous basis. So this process is called a risk management process, and this includes a risk management vision, and it's also your risk appetite. And this risk appetite could be different from one shareholder to the other shareholder or from one company to the other company. So one of the important steps here is to ensure what is the level of risk that we as shareholders are willing to take with our organization. And based on this level of risk, what are the expected returns that we have? So this relationship between risk and return is quite critical, and this is the time to reassess our risk appetite and reassess the sort of return that we could generate. Once you have done this, this is an example. This is a company in the fintech sector. They came up with a number of lists. I don't want to take you through it, but this is an exercise that we have done with the entire team, that they came here. We have put the probability high, medium plus, medium, low, etc., and we've put the impact. And for each of the high probability, high impact, we came up with a contingency plan. So this exercise we will be happy to do with you on a one-to-one basis, or happy to do with you, with your team, sitting down, listing them, prioritizing them, and including them in your risk mitigation plan. The next slide is about this is other examples. So you have different categories of risk. This is, for instance, the strategy and business model. The same way you might have finance risk, the same way you might have customer risk, sales risk. In this case, on the strategy, you might have one of the typical risk areas as you have a concentration with one account taking about 60 or 70% of your business, and this account is having delayed payment. So you have a concentration risk with one account, and this account is a late payer. It could be the government, and I've met with several of the companies, a hospital for instance, where more than 50% of the revenue is coming from one customer, and this customer is delaying payment for more than 12 months. Imagine the impact that you have. So what do? We have to diversify our customer base. Relying on one customer, so what we need to do is look at different market segments, look at different customers, and avoid at all costs to have a high concentration risk. So this is one example. Another example could be that you have intense competition. You find yourself with so many other companies entering and doing the same thing as you do. This is why it's critical for you to build up a competitive differentiation. Why you? Why should we as a customer come to you and buy from you? And what is this differentiation that you have? And technology is here to enable you to find out what is your differentiation, or what we call USP, which is unique selling proposition. A third example is the foreign exchange risk, and this is very typical in Lebanon. You are importing, and a lot of your import is in US dollar, and you're selling in local currency. So you find yourself with part of your structure is coming from USD, and the other part, the revenue side, so you have in Lebanese pound. So you have a mismatch. And the stronger is the devaluation of the Lebanese pound, the stronger is going to be this mismatch. And you need to address it. How do you address it? You look at your pricing strategy. How do you address it? By looking at ways where you could have not only your cost, but your revenue coming in US dollar. How do you do it? Finding export opportunities. How do you find export opportunities? By looking at potential markets, looking at partnerships that you do. So these are part of the contingency plan that we will be working together to identify. Another example here is that you don't know what are going to be the investments in the future. You don't know what your growth areas are. We sit down with you and we help you build this transformation plan. We help you identify what are these key growth opportunities. We'll help you quantify these growth opportunities, and we'll help you find the funding to be able to address these growth opportunities and for you to address. Another last example is that you have typically a lot in Lebanese family businesses, you have one owner controlling all the elements. If something happens to the owner, the company is at risk. So it's very important that one, you have a succession plan always, but most importantly is whatever is the knowledge in the heart and in the head of the owner, to put it in the standard operating procedures, to put it into governance structure, so that in case the owner is not here for a month, 2 months or a longer period, the company is not affected. So those are all examples of potential risk areas and examples of mitigation plan that we help it. This, what's important, is for you to understand the process. What's important is that we work with you in identifying these risk areas, mapping them, and working together on the mitigation plan. Now, once we have done this, what is the next slide? The next slide is you need to be able to track it. And how do we track it? I'll propose the balanced scorecard, but you could have different ways to be able to do it. It's very simple. Is you list what are the 3 or 4 things that are critical in terms of mitigation actions, and what are the 3 or 4 performance indicators that you have. So on one side here, and we put it into 4 buckets. The first bucket is the one on financials. So the question here is to satisfy our shareholders, what financial objective must we accomplish? And shareholders typically are looking for profitability, they're looking at growth, and they're looking at efficiency, that this is what we have. But in order to be able to achieve these financial goals, what customer needs must we address? This is very important, and here the customer are looking at price, they're looking at services, they're looking at the quality of your product. The third bucket is to satisfy our customers in which internal process must we excel. And these process could be sourcing or procurement, could be pricing, could be distribution, could be after-sales services. So we need to identify. And the last one, of course, is to be able to excel in these processes. What is the skill set that we need in our organization? So we have 4 buckets. One bucket, shareholders. It's about financial excellence. Second bucket is about customer excellence. What do we need to achieve this customer? And the third bucket is about internal process. So this is about efficiency. And the fourth one is about having the right skill set and empowering our people. Once you have done and answered these questions, then you put it on one sheet of paper. On one sheet of paper, you have your 4 themes. The first theme is on financial excellence. The second one is on customer excellence. The third one is on operational excellence. And the fourth one is, of course, on employee excellence and employee empowerment. And then what we do is we divide it into 2 categories. One category lists the performance indicators. These are the metrics. And these metrics could be revenue, could be profit. These could be your working capital management, could be the retention of your key staff. And we will work with you to identify what are these metrics. What are the key performance indicators that your company should have? And to support these, what are the 3 or 4 initiatives, mitigation plans that we want to implement in order to be able to deliver on these metrics? So to summarize it, we have what we call here milestones. These are breakthrough initiatives, building from your mitigation plan. These milestones are here to be able to fulfill metrics. These are the key performance indicators, and we've put it into 4 different buckets because these are different stakeholders at stake, from shareholders to customers to operation to strategic plan. So what are the key learnings in this workshop? The first learning that I've mentioned is identify, analyze, and evaluate your risk early on. Don't wait for the last minute to do it. And get help if you don't have that help to do it. It's a very simple exercise, but do it. The second one is you have to institutionalize it. It's not only in moments of crisis. This needs to be part of how you are managing your company. And if it was not, make sure that it is part of how you manage the company. The third element, not all risks are negative. You have some risks that have positive impact. You might not realize it now, but you would realize it in the future. So make sure that you look at these risks as an opportunity to be able to come up with a new product, a new service, a new channels of distribution, a new geographic opportunity that will come up. So keep this in mind in terms of learning. The fourth one that I said is that this risk register needs to be updated. It's not a question of doing it once and then sitting on it. This needs to be updated, if not on a 6 months basis, definitely on a quarterly basis that you have to do. I'm sorry, if not on a quarterly basis, definitely every 6 months. But in moments of crisis, we might have to update this risk register on a more regular basis. So this is important to note. Now, once you have a risk, it's not necessarily that I want to throw it out. You have different ways to go about mitigating on the risk. One is you could refuse this risk. I'm not going to take this risk. It's too much of an impact on our organization. This is one strategy, is you reject the risk. The second strategy is you accept it. I'm willing to accept the risk. My risk appetite is higher than it used to be, and I take this risk. A third one that you do is you might transfer it. You transfer it to your supplier, or you could transfer it to your customer, or you could transfer it to a shareholder. So this is another way of looking, is transfer the risk. Or the other one that you do if you don't transfer is you share it. You share it among. I take the example of a pricing strategy. I'm not going to price in US dollar because I'm going to lose a number of customers, but I'm going to price it in Lebanese pound at a rate that is between the official rate and between the black market rate. This is a way to share the risk that you have in terms of devaluation. So look at risk mitigation strategy, not only saying no or not only saying yes, but seeing how we can share it and how we can transfer it. This is an important exercise to take through. The last 2 points here is that always focus on what we call the red map. High risk, high impact, high probability of happening, and that you are prepared. You are prepared now, you'll be prepared in 2 or 3 months down the road to have the mitigation plan and to see what the impact would be. The last one is learn from the past. Don't repeat the same mistake. To have the mistake is fine, especially during these days. There is no way you're going to be able, so we will make mistakes. Accept your mistakes, move on with your mistakes, but learn from them and make sure that we don't repeat them, because this could be the kiss of death for a number of the organization. Thank you. This is the closure of the second workshop on risk management. Thank you.